Gold and its true price. When you hear headlines like gold hits a new record at $3,500 per ounce, it can trigger an immediate reaction. Some people feel excitement, others feel panic, and many think the same thing. Did I miss the boat? But the truth is that the number you see on the screen is only the beginning of the story. That price is the nominal price. It doesn't automatically tell you what gold is worth in real terms. Inflation changes what money means over time, so comparing today's price to yesterday's price without adjusting for purchasing power can be misleading. In other words, a record can sound dramatic, but it may not represent a true historic extreme once you consider what dollars can actually buy. Gold as a store of value. Now, why does gold keep coming back into the spotlight? Because it has a special role in human history. Gold is not just a commodity, it's a long-term store of value. It survives currencies, financial crises, policy mistakes, and even the collapse of empires. Paper money changes, governments change, systems change, but gold remains recognizable, tradable, and durable across centuries. That's why people often turn to gold in uncertain times, not necessarily to get rich quickly, but to protect wealth when trust in the financial system weakens. At its core, gold is closely linked to confidence. When confidence drops, gold often rises. Purpose of analysis. So what are we trying to do in this presentation? We're trying to see the full picture. We'll compare nominal prices with inflation-adjusted prices to understand what records really mean. We'll also look at gold's role inside the modern financial system, including how it's traded, how price signals are created, and why the market sometimes behaves in surprising ways. And finally, we'll connect all of that to expert views and long-term trends, because gold isn't just about today's chart. It's about time. It's about how value survives through decades. If you want to understand gold, you need more than a headline. You need context. Nominal versus real price. Let's start with one of the most important ideas in investing, the difference between what a price says and what it means. In 1980, gold peaked around $850 per ounce. That sounds tiny compared to $3,500 today, until you adjust for inflation. In today's money, that $850 is closer to about $2,800. That changes the story completely. It means that some of the biggest true peaks in gold happened in 1980 and again in 2011. So when we say today's price breaks records, it may only be slightly surpassing those historic moments once inflation is included. This is why inflation-adjusted thinking is essential. It protects you from being fooled by big numbers. Long-term growth. Now, zoom out even further. Since the end of the gold standard in 1971, gold has grown by roughly 7 to 8% per year in real terms, on average. That doesn't mean it rises smoothly. It doesn't. Gold moves in cycles. It can surge fast, then go quiet for years. But long-term, it has shown an ability to keep up with, and often outpace, inflation. And the reason isn't magic. It's behavioral and systemic. Gold tends to respond when uncertainty rises, when debt expands, when currencies feel weaker, when markets become unstable. It's not an asset designed for quick flipping. It's a stability asset, something people hold when the future feels less predictable. Trust and monetary systems. This brings us to the real engine behind gold, trust. Gold is not just reacting to inflation, it's reacting to confidence in the monetary system. When investors fear that currencies are losing credibility, they look for something outside the system. That's why central banks matter here. When central banks increase gold holdings, they're signaling something important. They want reserves that are not dependent on another country's promises. Confidence drives demand, and demand drives price. So if you want to understand gold, don't only watch inflation, watch trust. Because gold is, in many ways, a mirror. It reflects how safe people feel about money itself, how gold prices are set. When people think about the price of gold, they often imagine something simple: supply, demand, and a number on a chart. But in reality, the process is much more structured and global. One of the key institutions behind daily pricing is the London Bullion Market Association. For over a century, London has played a central role in determining benchmark gold prices used worldwide. These prices influence trading, investment decisions, and even central bank strategies. Every day, the global gold market aligns around these reference points. That means the price of gold is not random, it is the result of coordinated financial activity across continents. Paper versus physical gold. But here is where things become more complex. Not all gold trading involves real physical metal. In fact, a large portion happens in the world of paper gold. On exchanges like COMEX, investors trade gold through futures contracts, ETFs, and other financial instruments. The volume of these trades often exceeds the amount of physical gold that actually exists. This doesn't mean the system is broken, but it does mean that price formation is influenced not only by real supply and demand, but also by expectations, speculation, and financial positioning. In many ways, gold behaves like both a commodity and a financial asset at the same time. Market reality. We saw how important this distinction is in 2020. During the pandemic, demand for physical gold surged, and reports emerged that some vaults struggled to meet delivery expectations. This revealed a key reality. The gold market is a mixture of physical metal and financial promises. Prices can move based on fear, liquidity, and investor behavior, not only on mining output. Understanding this helps explain why gold sometimes rises even when production increases, or why prices can drop despite strong demand. The gold market is not only about metal, it's about psychology, finance, and trust combined. Gold versus real estate. To understand gold's real power, we need to compare it to everyday assets. Let's take real estate. In 1971, the average American home cost about 500 ounces of gold. Today, that same house can be purchased for roughly 200 ounces. That means something surprising. In terms of gold, housing has actually become cheaper over time. This doesn't mean houses lost value, it means gold preserved purchasing power. Instead of measuring price in dollars, we measure it in ounces. And when we do that, we see a completely different story. Gold becomes a benchmark of value across decades. Gold versus consumer goods. The same pattern appears with consumer goods. In 1980, a Mercedes S-Class cost about 10 ounces of gold. Today, it costs closer to 8 ounces. Again, gold's purchasing power remained remarkably stable. This doesn't mean gold always rises in price. It means it holds value relative to real products. When currencies change, gold often acts like a measuring stick. It helps show what money can actually buy. And that is why economists often analyze gold not as a luxury item, but as a long-term reference point. Gold versus stocks. Now let's compare gold with stocks. Over the long run, stock markets like the S&P 500 have delivered higher returns than gold. But those returns come with volatility, crises, and taxation. When we account for inflation, financial crashes like 2000, 2008, and 2022, and the emotional difficulty of staying invested during downturns, gold looks different. It may not grow as fast, but it preserves value. Gold is not an asset designed to outperform everything. It is designed to survive. And in finance, survival is sometimes the most important return of all. Taxation of gold. When people talk about investing in gold, they often focus on price, timing, and market trends. But one of the most important factors is often overlooked: taxation. Tax rules can significantly affect how profitable a gold investment really is. Different countries treat gold in very different ways, and these differences can influence where investors choose to buy and store their assets. Understanding tax frameworks is not just a technical detail. It can change long-term returns and investment strategies. European gold markets. Europe offers some interesting examples. In Germany, investment-grade gold is exempt from VAT, which makes it attractive for buyers across the continent. Switzerland, on the other hand, is famous for its stability and security. Investors can buy gold with minimal restrictions and store it in high-security vaults known worldwide. These policies create strong gold markets and attract international investors. Geography, law, and financial tradition all play a role in shaping where gold flows. United States tax rules. In the United States, gold is classified as a collectible. That means capital gains can be taxed at rates as high as 28%, often higher than the tax on stocks. This affects investor behavior. Some people hold gold long-term to delay taxes, while others structure purchases differently to optimize returns. The key lesson is simple. Gold investing is not just about buying metal. It is about understanding the full financial ecosystem, markets, regulations, and taxes together. Regular gold savings. Many people believe investing in gold requires large amounts of money, but history shows a different story. Imagine investing just $200 per month into gold consistently over time. This approach, known as dollar cost averaging, spreads purchases across different market conditions. Instead of trying to predict the perfect moment, you build a position gradually. This reduces the risk of buying at a peak and allows time to work in your favor. The strategy is simple, disciplined, and surprisingly powerful. Long-term results. If someone had followed this approach starting in 1985, today they would hold gold worth more than $320,000, more than the value of an average home in some regions. This is not the result of speculation or lucky timing. It is the result of consistency. Gold protected purchasing power across decades of inflation, economic crises, and currency changes. It didn't grow in a straight line, but over time, it accumulated value. Starting in 2000, even starting later, produces impressive results. If the same monthly investment began in 2000, the total value today would be around $140,000, nearly 3 times the amount invested. This demonstrates something important. Timing matters less than discipline. Markets rise and fall, but regular investment smooths volatility and builds resilience. Gold becomes not just a product, but a habit, a long-term financial routine, and over decades, routines often outperform predictions. Historical role of gold. Gold has never been just a financial asset. Throughout history, it has shaped empires, economies, and global power structures. Long before stock markets or digital currencies existed, gold financed wars, stabilized kingdoms, and symbolized authority. It was portable, universally recognized, and trusted across cultures. That made it the ultimate strategic resource. Even today, when financial systems are complex and digital, gold continues to hold that symbolic power, not just as money, but as influence. Alexander the Great. One of the clearest historical examples comes from Alexander the Great. After conquering Persia, he gained access to massive gold reserves. This wasn't just wealth, it was momentum. That gold funded military campaigns, supported logistics, and allowed expansion across continents. In practical terms, gold enabled strategy. Without it, sustaining such an empire would have been far more difficult. This moment shows how gold has always been tied to ambition, control, and geopolitical strength. Spain and inflation. Another story reveals a different lesson. In the 16th century, Spain imported enormous quantities of gold and silver from the Americas. At first, it seemed like limitless wealth, but the sudden increase in money supply triggered inflation across Europe. Prices rose, economies destabilized, and Spain eventually weakened despite its riches. The lesson is powerful. Gold can create strength, but it can also create imbalance if mismanaged. Wealth alone does not guarantee stability. Systems, discipline, and policy matter just as much. Government control of gold. Gold is not only tied to markets, it is deeply connected to politics. One of the most dramatic examples happened in 1933 in the United States. President Franklin D. Roosevelt issued policies that effectively forced citizens to sell their gold to the government. The goal was to stabilize the financial system during the Great Depression. Later, the government revalued gold at a higher price, strengthening national reserves. This moment showed that gold is not just private wealth, it is a strategic state asset. Impact on citizens. For ordinary people, the consequences were significant. They lost direct ownership of a resource that could protect against inflation and currency instability. Financial independence became more limited. Trust in government decisions became a central issue. The episode demonstrated how economic policy can directly affect personal wealth. It also revealed that gold is never purely neutral. It sits at the intersection of economics, law, and power. Lessons from history. The broader lesson is clear. Gold and authority are closely connected. Governments influence how gold is owned, traded, and valued. Economic decisions shape who controls resources and who bears the consequences. For investors and citizens, awareness matters. Understanding how policy interacts with gold helps people prepare for uncertainty. Gold is not just a metal. It is part of a system where finance and politics constantly interact. And history shows that those interactions can change the financial landscape overnight. Physical properties of gold. To understand why gold has held value for thousands of years, we need to look beyond finance and into physics. Gold is one of the most unique elements on Earth. It is the most malleable metal known. Just 1 gram can be stretched into a sheet covering nearly 1 square meter. It also has a distinct yellow color, unlike most metals, which appear gray or silver. This color is not accidental. It results from the way electrons behave under relativistic effects. In simple terms, gold looks different because of the laws of physics themselves. That uniqueness has always made it recognizable and desirable across civilizations. Durability and longevity. Another key characteristic is durability. Gold does not rust, corrode, or degrade like other metals. Almost all the gold ever mined in human history still exists in some form today: coins, bars, jewelry, or reserves. This makes gold incredibly suitable for long-term storage. It doesn't require special maintenance, and it can survive centuries without losing its structure. When investors talk about storing value, gold is a literal example of something that physically survives time. Gold supply limits. Now consider scarcity. Around 205,000 tons of gold have been mined globally. If melted into 1 cube, it would measure only about 22 meters on each side. Surprisingly small for something that has powered global trade for centuries. Each year, mining adds only about 3,500 tons. Meanwhile, the global population and financial systems grow much faster. This imbalance between limited supply and expanding demand is one of the reasons gold retains value. Scarcity is not a marketing idea, it is a physical reality. Gold in modern finance. Today, gold is no longer the official foundation of global currencies, as it once was before 1971. But that does not mean it has lost importance. In fact, central banks around the world continue to accumulate gold reserves. Why? Because gold operates outside the credit system. It does not depend on promises, debt, or interest rates. During crises, financial, political, or economic, gold often becomes a stabilizing asset. It is not used for daily transactions, but it remains a strategic component of global finance. Expert opinions. Many analysts and institutions see continued strength in gold's role. Demand is rising globally, especially from central banks seeking diversification. Forecasts from financial experts suggest that gold could reach higher levels in the future, with some projecting prices approaching $4,000 per ounce. Whether those predictions come true or not, the trend is clear. Gold is still treated as a safe haven asset. It is not tied to a single country, currency, or system. That independence is its greatest strength. Conclusion: trust and value. In the end, the true value of gold cannot be reduced to a single number on a screen. Its price reflects inflation, psychology, trust, and history all at once. Gold is neither inherently expensive nor cheap. It depends on how stable the surrounding system feels. When confidence in money is strong, gold becomes quiet. When uncertainty rises, gold becomes important again. That is why it has remained relevant for centuries. It is not just metal, it is a universal store of trust, passed from generation to generation, and likely to remain so far into the future.